thanks for your patience. This is Ravi. I am your instructor for today's class. Thanks for joining. Just as a brief background, for myself, I'm currently a member in the CPD committee of the CFA Society India. Prior to this, I was working with Northern Arc Investments, which is a specialized alternative investment fund manager which invests into high yield debt instruments. And prior to Northern Arc, I was working in mainstream investment banks like HSBC, JP Morgan, IFL Capital in various capacities relating to debt and the equity market. Okay, great. So, so you have the opening slide in front of you, which is basically an introduction into the alternative investment funds. We'll go through this slides, and I'll be happy to take questions from you towards the end of the session. If you guys are not able to hear me, I would request to refresh your browser. Let me just put that in as an instruction on the chat. Okay, great. So I'm moving on to slide number 2, which is what we'll be covering on today's session. So we'll start with an understanding of what AIFs are, the segmentation, the brief business numbers, as well as where the industry stands today. I think the best way to really understand AIF is to compare it to mutual funds. As you're aware, mutual funds are an investment vehicle which is very, very well understood by the masses. And I think what's really helpful in understanding AIFs is to look at the similarities, between the two platforms, as well as the dissimilarities, and basically look at AIFs as specialized kinds of mutual funds. And we'll do that. We'll cover the risk-return framework. Where do AIFs stand currently? We'll look at the key regulatory considerations. We'll look at the landscape of AIFs in terms of their investor participation. We'll cover some of the AIF industry best practices, as well as things that investors should keep in mind before investing in an AIF. Now, essentially, if you look at the alternative investment fund industry in India, it's quite recent. The regulations were introduced in the year 2012, so it's still a new industry. It has 5 years, under its belt. However, the precursor to the AIF regulations 2012 was the 1996 venture capital fund regulations. Now, the venture capital funds, as you're aware, and many of you would know, given that it was around for a much longer time before AIFs were introduced, are primarily vehicles to invest in unlisted equity. In fact, the venture capital tax regulations specify that venture capital funds need to invest at least 65% of their capital in unlisted equity. The balance can be invested in other securities, but essentially, what you see in the venture capital fund regulations was there was not a possibility of creating different kinds of investment vehicles. Essentially, a venture capital fund had to be either an angel fund or a plain vanilla venture capital fund or a private equity fund. So essentially, the foundation of the venture capital fund regulation was to promote investment into unlisted equity. Now, and pretty much, around, the year 2010, 2011, globally, if you see, there was a big move towards understanding and recognizing that while you have vehicles like, say, a mutual fund, where a retail investor participates, and that's quite well regulated, and, it allows different kinds, of funds to come. For example, under the mutual fund setup, you can have debt fund, equity fund, mixed, hybrid, balanced. So there are various kinds of funds that you can do. It was realized that while the mutual fund space really permits you to operate different kind of fund structures, its counterpart, which is the venture capital fund regulations, was really restrictive in terms of the kind of funds that you can launch. which is why it was superseded by the alternative investment fund regulation. Because what an AIF does, is it allows an asset manager to really float very very different kinds of funds. And if you look at the slide, post 2012, there are three categories of alternative investment funds that you can launch. There is a category one, category two, as well, as a category three. Now, what the category one fund, the way the government has defined it is, all, category one funds, will be funds which have a very positive spillover benefit, to the overall economy. So, for example, if you look at venture capital funds, social venture funds, SME funds, infrastructure funds, these are all funds which have a positive spillover benefit. Venture capital funds provides growth capital to startups. Social venture funds invest in social enterprises who are tackling social issues. SME, right? That's a category which has traditionally been capital starved, and an SME fund fills that gap. Infrastructure, we are aware of the infrastructure deficiency in India, and what if you launch an infrastructure AIF, that will again come under category one. Now, apart from category one, you have category two and category three. So what category three states is that if you are a fund which employs very very diverse or complex trading strategies, that AIF will come under category three. Now, category two is a residual category. So if you don't, come under category one, or if you don't come under category three, you can register yourself as a category two AIF. So immediately you see that, there is a possibility for conceptualizing different kind of AIFs, looking at which category it will fall into, and accordingly registering it with SEBI. So there was now a possibility of launching, funds which are very differentiated. It need not invest 65% in unlisted equity. It can entirely be, a debt fund as well. So that's essentially, the thought process behind an AIF, that it should really be a platform which should be well regulated and allow flexibility to the asset manager to launch funds beyond just a traditional venture capital fund. Okay, moving into slide number 4. One second. Yeah. So now, where does the industry stand currently? So the AIFs, as I mentioned, were introduced in 2012. Today, AIFs have capital commitments of about 2.8 lakh crores. So that's quite substantial, given that this is not a product which is sold to the mass market. It's sold to a very limited set of investors, and hence I think the capital commitments that AIFs have been able to raise have been quite impressive. It's still small compared to the mutual fund space, but that will always be the case because mutual fund is really a mass market product, whereas an AIF is much more selective. Now, in terms of number of AIFs, we have about 500 odd AIFs which are registered, with SEBI. And if you look at the different categories, the predominant, category, is category two, which is broadly in the range of about 50 to 60 odd percent. Then you have your category, three, which is in the range of about 20 odd percent, and the balance is category one. So category two is really dominant, as well as category three itself also has a very very high share. Now within category one, most of the funds are infrastructure funds. You have examples of social venture, venture capital, and SME funds as well. But predominantly, you're using the category one AIFs for investing in the infrastructure segment. Now this data which you see in the next slide, which is slide 5, that's based on internal analysis that we did. It's not publicly available. What we did was we looked at a sample of about 170 odd AIFs and tried to categorize them into different sectors and into different focus. The reason this slide it is very very important is it highlights to you the diversity within the AIF industry. So if you look at the sector, you have different kinds. You have a diversified AIF, you have real estate, technology, consumer, agri, infra, BFSI. So you have different AIFs focusing on different sectors, as well as AIFs which has a multi-sector approach. Now that's in terms of the sector. Now if you look at in terms of the instrument where they invest, predominantly AIFs are equity based, about 75 odd percent, but you also have quite a substantial number of AIFs which only do debt, right? And you have AIFs again which have a balanced approach as well, which invest both into debt and equity. Now, very briefly, what are the key terms for an AIF? Now, we're all aware of what these terms generally are for the mutual fund space. It's similar, as well as there are important differences. So I think the most important difference is AIFs have a very high investment threshold. So you require a 1 crore minimum investment size, investment ticket to invest in an AIF. Now that's to ensure that this product is outside the reach of most retail investors, given that an alternative investment fund typically invests in sophisticated instruments, generally takes higher risks, more sophisticated risks. It's only suitable for somebody with a high net worth, either somebody with a high net worth in terms of a individual, or is suitable for institutions which have the capability to understand the risk return framework within an AIF. So the way SEBI has ensured that an AIF will not reach the retail population is that it has kept the minimum investment size at 1 crore. There are some exceptions. For example, if you're directors or employees of the AIF manager, you can invest 25 lakhs. It's a lower threshold limit for them, as well as you can do a joint application up to 1 crore. So for example, if it's a husband and wife, they can, both of them together can contribute 1 crore in an AIF. Another important aspect of an AIF is it's a vehicle which has a sponsor contribution specified. So what does sponsor contribution mean? So the entity which is conceptualized and which is launching the AIF needs to have some skin in the game. So they need to invest themselves 2.5% of the fund size or 5 crore, whichever is less, as their own investment in the fund. And this is very important because what it means is that uh, managers also have skin in the game along with other investors. So it's basically a step to ensure that there is risk alignment between different counterparties in an AIF. This sponsor contribution requirement actually goes higher up if it's a category 3 fund, given that the category 3 employs very complex trading strategies. The sponsor contribution requirement for the category 3 is 5% of the fund size or 10 crores, whichever is lesser. The minimum corpus is 20 crores, which is to launch an AIF. Now, category 1 and category 2 AIFs have to primarily invest in the unlisted space. This is to ensure that there is no sort of overlap, between Cat 1, Cat 2 funds and mutual funds. The idea is to ensure that Cat 1 and category 2 funds essentially operate in the unlisted space. If you want to do, a listed investment, you have to go as a category 3 AIF. So for example, you can register yourself as a category 3 AIF and then entirely invest in the listed stock market. Category 1 and category 2 AIFs have to have a minimum 3-year tenures. Category 3 AIFs can be open-ended or closed-ended. So if you really want to launch an AIF which investors can come in and go at their will, there's only one category which permits it, which is category 3. Otherwise, Cat 1 and Cat 2 has to be a minimum 3 years closed-ended fund. And it's quite, the reason actually becomes quite clear because see, Cat 1 and Cat 2 AIFs are investing in primarily in the unlisted space. So it also means that they will not be having liquidity. Unlisted securities are not easy to trade in, which is why SEBI has made these funds mandatorily 3-year closed-ended, 3-year or higher. Now, if we look at leverage, category 1 and category 2 AIFs can employ very small leverage. If you want to do a very complex leverage fund, you have to register yourself as a category 3 AIF. Registration for an AIF typically takes between 1 to 3 months, depending on how well the documents are prepared, as well as how quickly you're able to address the queries that SEBI may have with respect to that product. Single party exposure is significantly higher, as compared to mutual funds. AIFs even permit up to 25% investment into a single party. And this 25% comes down if it's a category 3 AIF. In a category 3 AIF, single party exposure has to come down to 10%. But for category 1 and category 2, you can get away with a 25% single party exposure limit. There are rules in place to ensure that the terms and conditions of the EIF are not changed midway, which is why you require a supermajority approval of the investors before carrying out any material change in the AIF, either relating to its investment strategy, investment philosophy, or with respect to its management, or with respect to its cost or return profile. Okay, so we come to slide 7. As I highlighted, uh, one of the easiest way to actually look at AIFs is to compare it with mutual funds. So, this is a brief comparison in this slide as well as in the next subsequent slide. Now, if you look at the legal structure of an AIF, it can be set up as a trust, it can be a company, limited liability partnership, or a body corporate. Mutual funds, as you're aware, are set up as a trust, but an AIF can be set up under different legal framework. However, about 95 to 97% of AIFs are all set up as trust. So in that respect, AIFs are actually very, very similar in terms of the way they are structured to a mutual fund. What really happens in a mutual fund is there is a trust, which is actually the fund, where the money actually comes in and where the investments are held. The trustee is the body which is responsible for the affairs of the trust. However, the trustee may not have the expertise of capital markets, which is why the trustee company appoints a asset management company, right? So if I were to take an example of, say, a mutual fund like an HDFC mutual fund, the mutual fund itself is a trust. There is an HDFC trustee company, which is responsible for managing the affairs, of the mutual fund, which is the trust. Now, given that the trustees, may not want to manage the day-to-day affairs of the trust, as well as they may not have the requisite expertise, they appoint an asset management company, which in this case is HDFC Asset Management Company, which manages the day-to-day affairs of the mutual fund. And what the trustee do is they manage, they maintain an oversight function. So the day-to-day affairs are taken care of by the AMC, and the trustee is sitting in the background, ensuring that the show is running well, all regulations are taken care of, and all compliance, is being done. Now, AIFs are exactly similar. An AIF is generally mostly always a trust. There is a trustee company. In most cases, the trustee is a corporate trustee. In some cases, and even an individual can be a trustee, but mostly you will see that there'll be a trustee company. There are many companies, financial services companies, which provide trusteeship services, like for example, all the major banks, and then there are specialized trustees as well. So these trustee companies, are responsible for managing the AIF, of course. Again, what they will do after the creation of the AIF is they will immediately appoint an asset management company, which in this case is an AIF manager, and that AIF manager will look after the day-to-day affairs of the AIF, and the trustee will be in the background and will be ensuring that everything is as per the law. The fund is being run as per all SEBI guidelines. So very similar in terms of structure. In the case of a mutual fund, a sponsor and a manager have to be different entities. So for example, HDFC AMC, is the manager of HDFC mutual fund schemes. HDFC Limited acts, as the sponsor. So there are two different entities. In the case of an AIF, manager and sponsor can be the same, or they can be different depending on the convenience of the entity which is setting up the AIF. There can be different type of funds similar to mutual fund. Mutual funds can be open-ended, closed-ended, similar in an AIF. Both mutual funds and AIF have minimum corpus requirements. While mutual fund does not have a regulatory minimum that you can invest, is depending on each AMC. AIFs have a minimum investment of 1 crore, like we discussed earlier. Coming to slide 8. Now, both mutual funds and AIF have a continuing interest requirement, and as you can see, AIF has a much higher continuing interest requirement. So, by continuing interest, what I mean is the manager or the sponsor, have to mandatorily invest, in the AIF alongside the investor. Now, mutual funds, I think this is a very, very important difference. If you look at a mutual fund, it can, the units can be subscribed by way of a public issuance. Now, what I mean by a public issuance is the mutual funds can really, offload its units in the broader market publicly. It can do public advertisements, and it can reach out to all and sundry without any restrictions. An AIF cannot do that. So first, when an AIF is, say, coming up, with a private placement or a new fund offer. So you see in the newspapers, right? Every time there's a new fund offer, a mutual fund will have large advertisements. It will seek participation from a broad range of investors. You will never see such an advertisement for an AIF. An AIF will never advertise in the paper or in a magazine or in billboards, that is coming up with a new fund offer and asking for investors to invest. That is because AIFs can only offer units for subscription through a private placement. Now, what does private placement mean? It means it can only be shown selectively to a certain class of investors, and it cannot use any public advertorials. At the same time, an AIF manager has to ensure that none of its offer documents, are publicly available for an investor. This is to ensure that an AIF which has been designed, keeping in mind uh, you know, uh, a certain investor class. It is only marketed for that investor class, and it's only done so selectively. And this is to ensure that retail investors do not mistakenly also invest in an AIF. It is perceived that AIFs, are a product, for a typical, investor segment, and within that typical investor segment, they will have segmentation within that. And the idea is really to ensure that an AIF is only reaching out to those limited set of investors. Listing, listing is permitted in the case of an AIF after the final close of the AIF has happened. However, currently there are no AIFs which are listed. So I think it'll be a few years before we see AIFs getting listed in the market. And even if AIFs do get listed, the trading lot, will be at least 1 crore to again ensure that no retail investor is able to invest in it. Minimum tenure, we discussed it earlier, has to be at least 3 years for category 1 and category 2 AIFs. For category 3, it can be open-ended. And AIF cannot have more than 1,000 investors. In fact, most AIFs never reach, 1,000 investors. You'll generally see AIFs, in the range of about 20 investors, 30 investors. Some of them will reach about 100 to 200 odd investors. Okay, we'll come to slide 9. So now, essentially, if you look at, what we have covered till now, it becomes very evident that an AIF is a product which is really targeting, upwards of the medium risk investment space, and accordingly, is also offering a much higher yield or the pre-tax return. So it's essentially operating at the higher end of the market, which is generally high risk, high return kind of, investments. While the low risk and the medium risk space is very well catered to by the mutual fund. The reason why AIFs are becoming very, very popular over the past 5 years and the industry has really grown is it provides really good, regulatory and a fund platform to launch different kind of products, complex, sometimes not that complex, but essentially, going into, the higher risk, higher return category. And the reason for that is quite straightforward. If you want low risk or medium risk, you'll essentially, have a lot of investment options in front of you. Like for example, GSECs, commercial, certificates of deposits, you have bank FDs, you have the various kinds of small saving schemes of the government, you have AAA bonds, right? So you really don't need Anything else, you can go and invest in all of these papers and earn lower return but at much lower risk. And of course there are various kinds of mutual fund products which allow you to take higher risk, like small cap, mid cap, large cap diversified funds which satisfy your appetite for a medium risk, medium return kind of appetite. Now, the moment you come to AIFs, for example, an AIF can be a VC fund, it can be a direct real estate fund, private equity fund, and those are all targeting yields upwards, of 18%, in fact, going up to, higher 20s as well, depending on the kind of fund. Again, you can have AIFs, which are sort of balanced AIFs, which have both characteristics of debt and equity. So, like for example, venture debt or hybrid or structured paper, kind of AIFs, which will target, about 14 to 16, kind of, yield. So essentially, I would say that, an AIF territory generally starts, at yields higher, above, 13 odd percent, and going up right up to even 30%, depending on. So for example, an angel fund, which really invest in very, very early stage, companies, they can even give yields and target internal rate of returns higher than even 30%. Coming to the next slide, we have covered most of the stuff here. We talked about private placement, we talked about the number of investors that an AIF can have, we talked about the minimum commitment which is required from the manager or the sponsor of an AIF. Conflict of interest in an AIF, if any, have to be properly disclosed by the manager and sponsor to an investor. And there are very, very strong regulations by SEBI to ensure, that if there is any situation where the manager or the sponsor is conflicted, those have to be, disclosed to the investor. The taxation of an AIF is very complicated. Over the years, what we have seen is the tax department has worked towards making AIFs taxation, more simple. And in fact, for at least for category 1 and category 2 AIFs, they are fairly simple now. Category 1 and category 2 AIFs are tax exempt vehicles, uh, which means that the fund themselves do not have to pay any tax, like, for example, a mutual fund. But only any income that is distributed by a category 1 and category 2 AIF, there has to be a 10% withholding which has to be done. Uh, but the investor gets credit for this 10% withholding, so it's not a tax leakage. It'll reflect in the Form 26AS. Category 3, taxation can be quite complex. It again depends on the kind of funds, the kind of the legal structure, which is there in, in the AIF. However, essentially, the idea behind an AIF really is that given that it's an investment vehicle, most managers will structure the AIF to ensure that it's a tax pass-through, and taxation should happen at the investor's end as per the maximum marginal rates applicable to them. In some cases, the taxation can be at the fund level, in which case investors will either have a communication from the manager that all tax have been discharged and hence no additional tax needs to be paid for their investment, or they will directly receive tax credits in their Form 26AS, allowing them to, avoid a situation where they are taxed twice. So I think, taxation, while compared to mutual funds, is a little complicated. However, I think the industry has made a lot of progress. The tax department has made a lot of progress in terms of ensuring that AIF taxation, is straightforward. And in about 2014, 2015, so I see a comment tax implications under category 3. See, while for category 1 and category 2, the tax laws explicitly specify what their taxation is. So in that respect, barring a few points, it's quite straightforward. Whatever cat 1 and cat 2 AIFs earn, you pay a 10% withholding and give the income balance income to the investor. And because investors are receiving the 10% withholding, as a tax credit, it's really sorted out, the taxation. So category 3 AIFs, there are no specific guidelines as to how a category 3 AIF has to be taxed, which means the taxation of a category 3 AIF, depends on what is the legal entity of an AIF. Now, we spoke earlier that most AIFs, are registered as a trust. So, which means the taxation for a category 3 AIF will be as per the taxability of a trust. However, trust taxation is generally very, very complicated. It depends on several factors in terms of how the trust is structured, whether it's a determinate trust or an indeterminate trust, revocable or irrevocable trust, are the beneficiaries identifiable or not. So mostly, the taxation can differ, but would just like to leave you with this thought that, there will not be a situation where an investor is taxed twice, because that's clearly not the idea behind an AIF. If the taxation is at the investor's end, the fund will not be taxed. If the income in a category 3 AIF is being taxed at a fund level, then it'll be tax-free income, for the investors. I see another comment. What about taxation for US and Canada? Again, that depends on so many factors. It's not possible to actually have a straight answer for that. It depends again for what is the category of the investor, what is the route behind which they are investing, from which accounts the money, is coming. Okay, so, and we covered a bit about, just mentioning about foreign investments. So AIFs can take in, money from foreign investors, and they did not be registered as an FPI. They did not be registered as anything. As long as you are routing the investment from a country which is has a green code as per the Financial Action Task Force, which essentially just means that if it's a jurisdiction, which is a clean jurisdiction, barring, places like, for example, say Afghanistan or, certain countries in the Middle East, you're pretty sorted out. That country just has to, be a Financial Action Task Force signatory, and you're good to take in money. Of course, there's several other considerations, which you will have to think about, which relates to taxation, as to from which jurisdiction the investor is investing. Is it being, what kind of vehicle the investment is being made through, as well as, what the income stream, will be of that AIF. Now, accordingly, the taxation, for foreign investors is entirely as per the double tax avoidance agreements, which is there. I Category 3 AIF, can we set up a structured product? Absolutely. Category 3 AIFs, you can do pretty much anything. So see, AIFs is a vehicle where you can do anything. Because SEBI is restricting, participation in an AIF, to a high net worth individual or to institutions, you give manager the flexibility to really, work on different instruments. So AIF can pretty much invest in any security, out there, without, any risk. It can invest in derivatives also. There are a lot of long short funds, for example, in the category 3 space, which target an absolute return irrespective of, what the markets are doing. In fact, the bulk of the AUM within the category 3 AIF are long short funds, which employ, a lot of derivative strategies. It says you give a 10% TDS, but what is the actual tax rate? So the actual tax rate depends on what is the income, of the AIF. So for example, if an AIF is earning interest income, it will be fully taxed. If an AIF is earning short-term capital gain tax, it will be taxed as per short-term capital gain taxation. If it's earning long-term capital gain, for equity, it's 10%. So the 10% withholding is a blanket 10% withholding, irrespective of what's the kind of income which the AIF is earning. Balanced taxation has to be at the investor's end, depending on what kind of income is being earned and what is the tax rate that the income tax department has specified for that type of income. Coming to the investor landscape, now, so I have a comment by Mr. Sharma, which says DTAA. That's double tax avoidance agreement. So, depending on which country the investor is investing into an AIF from, India will have a double tax avoidance agreement with that country. Now, that double tax avoidance agreement, talks about what will be the taxation between, that country and India for the separate, kinds of income which the AIF can earn. Now, bank, bank treasuries can invest in AIF. You have pension funds which invest in AIFs, insurance companies, NBFCs. Now, each of them, have different requirements, and they invest in different types of AIFs. Pension funds, for example, invest in long-term AIFs. Insurance companies invest in very, very long-term AIFs. NBFCs and bank treasuries prefer AIFs which have more, liquidity support coming in into them. You have on slide 2 the retail and the international investor. The retail investor, we talked about the minimum ticket size, so it's essentially a product which is there for the HNI market, the ultra high net worth individual, family offices. uh, you know uh, and in the case of the international investors, as I specified, the tax rates will be as per the DTA what they specify. uh, However, if an investor is directly investing into an AIF from abroad, they will require a PAN card, which is why mostly when you're investing capital from outside into an AIF in India, we generally pool it at either Mauritius or Singapore or Cayman, and then you route the investment into India, so that ensures that the investor doesn't need to even have a PAN card while investing, into an AIF. Now, we'll come to slide 13, which talks about the industry best practices, and I'll keep it brief here, but this is really for you to think about any AIF that you are evaluating. What are some of the things that you should keep in mind? Now, the SEBI has specified what the manager or the sponsor continuing interest should be. However, most managers go beyond the regulatory minimum, and this is to ensure that they have a much higher skin in the game. It helps, in communicating to an investor that the manager sits exactly alongside them and participates, in the risk. You have to be really careful in terms of what the reporting of an AIF should be. Regulatorily, it's quite low. For example, an AIF is required to do semi-annual valuation. You should check, with an AIF at what frequency, they will report on the portfolio, on the NAV statements, valuation. The reason this is quite important is in the mutual fund space, you really take all of these things for granted. Whereas in the case of an AIF, given that these are complex products which may not lend themselves to high frequency valuation, SEBI has been quite lax in terms of specifying, what the reporting mechanisms should be, and hence you should double check the documents to see that you are really getting all the suitable information that you require to evaluate your investment into an AIF. You should be very careful in terms of the deployment period. AIFs are products which can have very, very long deployment periods. So a private equity fund, for example, can even take 3 years to deploy the capital that it has raised. You need to carefully see what's the upfront cost as well as the management fee. In the case of a mutual fund, entry load has been banned. In the case of an AIF, they do come with their own upfront cost, and the management fee can be very uniquely calculated. They can be dynamic management fee calculation, they can be carry, they can be watermarks. So you need to see what really goes behind the cost of that AIF. If you go to the next slide, deemed consent is a strict no-no. Contribution. So see, when you're investing in an AIF, everyone is signing one standard application form. That's not the case in an AIF. An AIF investment is a tripartite agreement between the trustee, the manager, and the investor, and that agreement can differ from investor to investor. So generally, you should ensure that the manager or the sponsor are using a standard agreement for investing. This is to ensure that all investors who invest in an AIF are really equal. There can be compensatory payments between investors, given that I talked about deployment period for an AIF can be quite long. So somebody can invest in year 1, somebody else can invest in year 3. And there has to be a mechanism to ensure, that the year three investor is participating only in income post their investment. Some AIFs even offer investment committee seats to, investors. So what are some of the rights of the investors relating to documentation? AIFs generally have a contributor give back provision, which specifies that even though you are investing in an AIF and you're earning the return, and even post it's distributed, you can still be asked to give back those return if in case there is any litigation. You should check the indemnity clauses. You should check the reps and warranties provided by the manager or the sponsor. Side letters. Side letters are an arrangement, that a manager gets into with another investor, which is not applicable to all investors, but only specific to him. So you should ensure that side letters are to a minimum and only for situation in which is absolutely important. You should check whether the investment manager can be removed by the contributors in case they're not performing well, and can the trustee or the manager, be removed as well, and what is the cause for which they can be removed, as well as what kind of voting mechanism to ensure how such removal will happen. There could be restrictions in secondary trading of any AIF units. Yeah, so in case your client or you yourself are investing and you want to trade in the AIF units in not in the listed market, because it's not, AIFs are generally not listed. None of them are listed currently out of the 500 AIFs. So if you want to do an over-the-counter trade, you should ensure that there is no restriction in terms of secondary trading. And very, very important, to see the cost and expenses behind. Yeah. Okay, so I am towards the end of the presentation, so I'll stop here, and really happy to take questions from all of you. So I'll keep my eyes on the chat window. I think I have a first one. Can withholding tax vary in category 3 AIF? So category 3 AIFs do not have any withholding specified as per the Income Tax Act. So the withholding for the category 3 AIF can differ, and the taxation methodology really depends on the manager, as well as it depends on what is the kind of income that the fund is earning. So there is no stipulated withholding tax specified for the category 3 AIF. Now, then I have a comment which says show me slide 5. So let me just go to that slide. Okay, that's slide number 5. So see, we have another comment which is not clear on the difference between Cat 1 and Cat 2. So essentially, there is no difference, as such. It's you can have a fund and register it as a category 2 as well, or you can register it as a category 1. The reason why managers will pay very close attention to the nitty-gritties or the difference between different categories will be that each category of an AIF comes with their own set of investment restrictions. So for example, if you're going with a category 1 venture capital regulation fund type, you'll have to invest 65% in unlisted equity. If you're going in category 1 social venture fund, you have to mandatorily invest in social enterprises. If you're investing, if you want to do a debt fund, given that category 2 was a residual category where you can do anything in terms of your investments, you will register yourself as a category 2. So essentially, there is fungibility between different categories, and managers generally choose the categories depending on what is suitable for the kind of investments that they want to take. So we have a comment: in case of listed space of category 3 AIF, what would be the taxation? It will actually be exactly, so for short-term capital gains, we know the tax rate 15%. For long-term capital, it will be 10%. So the taxation for the category 3 listed AIF will be exactly as per. So the important thing to keep in mind is that for the category 3 AIF, there is no taxation for specified for category 3 AIF. It all depends on where the category 3 AIF is investing and what is the kind of income that it is earning. So it's immaterial that it's a category 3 AIF. What is important is what's the structure. So it's a trust structure. So taxation will be as per the trust, and within that trust, the applicability of the different tax rates will be as per the different income streams, which they earn. So who can be the distributor of an AIF? Anybody. Anybody can distribute an AIF. You don't need an ARN number, or you don't need to be registered with AMFI. Hitensha, you're not clarifying rate for Cat 1 and Cat 2. So Cat 1 and Cat 2 have to have a 10% withholding. So who are the major AIF players? One second, I'll just put it on slide 2. Slide 1 and slide 2 are actually just the content pages. So I've put it on slide 3. So there are several AIF players in the market. So, for example, Avendus, is a large AIF player. IFL, has many AIFs. All the major guys, Kotak has AIFs, Axis has AIFs. There are a lot of specialized players into the AIF market. So Bearings, for example, Milestone is there. So Edelweiss AIFs are there. So there is a lot of AIFs. So I talked about the numbers. There are about 500 odd AIFs in the market. Okay, so there is one comment question which is actually a very good comment. Why to invest in AIF over a mutual fund? So see, mutual fund, given that it's a way an investment vehicle which is marketed to the retail population, there is only so much that you can do. There is a much higher scrutiny, and you will generally restrict yourself to traditional instruments. However, if a investor, has an allocation for say a 10% of his portfolio, which is really willing to take risk, he is aware that he wants to earn higher return, and he is aware that he's taking higher risk. He can allocate it to alternative investment funds where the investments are non-traditional generally. So you will have a lot of instruments which generally a mutual fund does not invest in. So for example, an AIF can invest in unrated debt. A mutual fund will never invest in unrated debt. Mostly it'll be in the range of double A rated, sometimes triple B. An AIF can invest in any instrument. It can invest in hybrid instruments, which can invest in warrants. It can invest in security receipts of an asset reconstruction company. It can invest in direct real estate. It can invest in units of REITs, INVIT. So any historical data of return is available by Sanjay? No, but like for PMS, you have that option now. For AIF, no, but SEBI is considering it, and I think we might see in the future publication by various AIF managers of what is the return that they have earned. Hedge fund versus AIF, Rohit Gupta. So category 3 AIFs are generally hedge funds. They employ complex derivative strategies and they hedge. So it's not versus an AIF. Hedge fund is actually a type of an AIF in India now. AIFs invest in P2P lending. So an AIF cannot make loans. So there was again, this question is actually linked to question by Rahul Saria as well, NBFC versus AIF. An NBFC can make loans. An AIF has to mandatorily invest in a capital market instrument. So it cannot make a loan. It can invest in equity shares. It can invest in bonds, listed or unlisted. So whatever an AIF is investing in has to be a security. So an AIF cannot make loans. And that is to ensure that an AIF doesn't get into an NBFC territory. So for difference between AIF domiciled in IFC like Gift City. So see, essentially you will go to Gift City, and the rest of India. See, if you're attracting foreign investors, then you would like to go in an international finance center like Gift City, which will have certain benefits, over having the AIF. So for example, if you have an AIF in India, when you're charging the management fee, you'll have to pay GST on it. Right now, as a foreign investor, because if you have foreign investors in a fund, it's an export of management services. So essentially, no GST should be applicable. So you might, go and register yourself in the gift city because you want to save up, on that GST. So there are certain other benefits, mostly applicable for foreign investors. So you go to a gift city or international finance center for mostly an AIF which are targeting, capital from abroad. Yes, so AIF can invest in debentures. It is a debt. Yes, it is a debt, but it's a debt security. So there's a difference between investing in a bond and making a direct loan. Sanjay and Mehta, what is the ideal allocation for an AIF? So again, this really depends on investors' appetite. There can be no standard answer for that. However, given that an AIF requires a minimum investment of about 1 crore, you're really, and you wouldn't want one single AIF to be say more than 5% of the investors' portfolio. So you should really looking at a portfolio about 20 to 25 crores of investable surplus. You can allocate to one AIF 1 crore, and that's about uh, about 5% odd in terms of exposure. So you're really looking at large portfolios where any AIF investment can be made, and how much they can allocate really depends on their risk appetite. So, an interesting question: how will AIF be a value add for an investor? Again, if you want to really diversify, so most investors, right, have safe investments, like your tax-free bonds and your well AAA rated bonds, and they'll have listed equity. They could even have exposure to some unrated, papers. Now, if you want to diversify beyond all of this, right, so that's where an AIF comes into the picture. So an AIF can, for example, invest in unlisted equity, right? So if an investor wants to, have private equity investment or venture capital investment, so there are a lot of structured products. So within the debt space, for example, there are a lot of high yield debt products giving 17 to 18% kind of returns. So if an investor really wants to diversify his portfolio away from traditional instruments, that's where an AIF really adds value, because the kind of instruments that an AIF invests in, you will not see other investment vehicles investing in that. So that's the value add. Of course, there's a downside to it also. Risk has to be properly evaluated. Overseas investors don't need PAN for investing in AIF. No, they do need a PAN. If you are directly investing in an AIF, a PAN is mandatory. If managing HNI clients, which registration is preferred, PMS or category 3? So see, the key difference between PMS and an AIF is the PMS allows you to have tailor-made investment strategy for each client, right? Every client can have a different investment strategy. You may choose to club different investors into one particular strategy, but as a vehicle, it allows you to have tailor-made investment solutions for each investor. An AIF is a fund vehicle. So it means it is pooling capital from different investors and into a one single investment strategy. So here also you can have different schemes of an AIF looking at different investment strategies and then club investors within that. However, if the idea really is to provide very, very personalized, tailor-made investment solutions, AIF is not the product, because AIF really works when you bring investors together and invest in one single strategy. Whereas a PMS can really be customized for each investor. So if you want to, which is a question, Old Bridge Capital, how would we know how many AIFs is running? The entire list of 500 odd AIFs is available in SEBI's website. So you can check each AIF, which category they are present in, as well as it has the contact details also if you want to reach them. Yes, category 1 AIF does not, category 3 AIFs need not be close-ended. So category 3 AIF, can be both open-ended and close-ended. So there can be a category 3 AIF where there is no minimum, investment tenure. So yes, there are extensive information source for AIF data. You can look at Nishit Desai's fund structuring booklet. SEBI itself, I talked about, SEBI discloses the entire business volumes in an AIF, which categories has raised how much money, as well as registration. And very soon, I think we'll also have performance data coming in. So there are a few sources, but essentially, given that it's a private placement market, you will have trouble information relating to AIFs, because the intention from SEBI side is clearly not to have this information publicly available, because it can mistakenly, lead to an investor investing in an AIF where they may not fully understand the risk. So we have another question, and uh, I'll keep this as the last question. So what is, I think, as the important question is, what is the reporting mechanism behind an AI, what kind of reports they can expect. Like I said, an AIF regulations specify very minimal investment reporting to be done. The reason is AIFs, for example, a mutual fund, the kind of instruments that they invest in can be valued daily. Whereas an AIF technically generally invest in unlisted instruments, so it's not possible to value them on a regular basis, which is why uh, you know you uh, you generally have an AIF disclosing information at best case quarterly, sometimes monthly. So depending on the kind. So, for example, if it's a category three AIF which is investing in the listed space, you can still have a very very strong reporting mechanism where you can even disclose a daily NAV. But most AIFs will give you NAVs on a monthly or a quarterly basis, and even the fact sheets would generally be in the quarterly or the semi-annual frequency. Uh, Purandar Sai Govind Chundris asks, what are the opportunities that we have if we are certified in alternative investments? See, an AIF segment is a very, very high growth, industry. It's come from, zero to about 3 lakh, odd crore capital commitments rates, over a period of 5 years. So the advantage of getting into the AIF industry is it's really a sunrise and a nascent industry. So the growth opportunities will be tremendous. We do see a lot of investors coming into AIFs, and so it's an exciting space to be in because you'll have a lot of opportunities, a lot of new managers coming in, a lot of new stuff to be done. Same time, you also have to be aware that any new industry comes with its own risk. For example, in a mutual fund or a PMS space, because these vehicles have been there for quite some time, so you really know what to expect, from them. In an AIF, it's new, so definitely a great career for little, adventurous people. I have personally been involved in the AIF space since 2012 when it was launched, and I have witnessed before me how the industry has really grown. So it's a terrific industry, and I'm sure it's going to grow very well going forward. Okay, I think guys, thanks a lot for joining in. Apologies for the sound trouble at the start. I hope this was an interesting session for you guys. Maybe we'll do this again, and I'm happy to address the balance queries. This session is recorded, so you can access this later. And as always, Google will have a lot of information, even on a restricted basis, relating to AIF. So do check out. There are a few mission documents relating to AIFs, and to look at the presentation for a lot more information. And that's it from my end. Very good evening to all of you. Have a great evening and a very, very good weekend. Thanks.